So Barry, what do? Do you buy into the optimism on U.S., China, and the markets that we've seen on this final trading week of the month of August?
No, Sarah, I can't believe that any self-respecting deal maker would fold right now for a multi-year truce or deal. You've got China's economy leaking over to the consumer side, weakening. You've got Europe in trouble in the continent, and you want Brexit to go more towards the UK way. Most importantly, you've got the Fed meetings coming up, and you really want rate cuts. Why would you settle now? So there seems to be a little misplaced optimism there, at least as far as I can tell.
You're saying why as President Trump, would you settle now?
Yeah, let's face it, he's running this trade negotiation. It's being done at lower levels by functionaries, but the policy overall is being set in the White House. I just don't think that there's any great rush. And as the market figures that out, as the month progresses, we might get lower prices in the fourth quarter, particularly if the Fed drags its heels on rate cuts.
Brian, the bond market is kind of dictating the terms of this debate in a large degree. We were just talking about it. Obviously, you've had this recent pretty steady flatness of the yield curve, and yet credit markets have been okay. So it's not as if necessarily the entire bond market is declaring a recession is on the way. Where does all that bring you?
Well, for our team, the way that we're positioning portfolios is still favoring adding some of the credit risk, but in a very judicious way. And I think that you're absolutely right. We've seen that Treasury yields have fallen. They don't seem to be able to get back up. But yet, if you look at credit spreads, those haven't blown out. And in the past, if you look at what are those conditions that say that a recession is more imminent, it's usually about the inverted yield curve and the spreads widening. Now, that's not to say there won't be a recession, but it's an imperfect indicator as to when. Will it be a slow slide over the next 2 years or how long, right? So it's not a very good indicator about when it will happen. And so given that what our take is that we will likely see a continued economic slowdown, but not enough to really see a dramatic increase in defaults. And as a result, on the fixed income portion of our portfolios, we still do like adding that credit risk. But at the same time, we're not that afraid of adding the duration risk. We think that we're kind of stuck in a somewhat slow, sluggish growth environment with very low, slow inflation. And that means that yields are likely to stay range bound.
How are you going to get a return then for your clients if you're putting them in to credit right now, Brian?
Yeah, well, believe it or not, there are plenty of opportunities for credit. If you look at the lower quality investment grade, higher quality, high yield, if you look at emerging market debt, CoCo bonds in Europe, pan-European high yields. So it does involve really moving out along the risk spectrum a little bit more. We manage multi-asset portfolios, and so when we're creating a multi-asset income type strategy, we're also adding global dividend yield stocks. Also, an interesting dimension, too, is I don't think that investors should be so fixated on just clipping coupons and collecting dividends. They can also consider what is the total distribution potential of their portfolio. It's not just about the income, but can you create your own income by having more, even tapping into some of the capital gains that you've accumulated?
To that point, Barry, I mean, do you think that we are at a point now where investors should be more aggressive buying dividend-yielding stocks that are yielding so much more than treasuries? I think more than the 30-year treasury for the first time since the last recession. Where are you on that?
Yeah, we've been positive since last summer on the bond proxy defensives, the staples, the REITs, the utilities. When you look at the mild recession of the early 90s and the early 2000s, very mild, the real yield, the 10-year TIPS yield or the real yield fell about 100 basis points. We started June 20th at a 50-day moving average on the 10-year 3-month curve inverting. That's been a reliable signal, no false blips. The real yield then was 25 basis points. So there's no reason we can't go to a minus 75 basis points on the TIPS. And that's how you actually make some money on credit as well. I heard the earlier discussion. You'd be looking at a 10-year yield of somewhere around 75 basis points. And that's with a very mild slowdown that doesn't really hit the consumer side as much as the corporate side of the economy.